Okay, so Linktree is a great tool. You guys may want to know about it anyways, but it's linktr.ee. So the dot is right in the middle of the word tree. Okay, so it's tr.ee and then you / Julie Downey. Okay, so not everything is on there yet. It will be soon. So that's what I'm working on. But last week's is on there. This week's will be on there as soon as I can get it up today. And then the script book will be on there and all sorts of things. The other thing that's on my link tree is invitations to my stuff. So tomorrow I'm doing the hot mess. I'm going to I'm going to share my top 6 strategies to help you gain control before you start next year. So if you want to register for that, it's also on the link tree as well. So, okay, Susan, so plan on bookmarking that link tree for everything you want and need from here on out. You're welcome. Yes, I'm happy to have that going for everybody. Okay, so as people hop on, I'm hoping someone will help me and tell me a little bit about what you learned, what ahas you have from our conversation last week. So last week we were talking about just the overarching economy of the country and kind of what affects rates and that kind of thing. Can anyone share with me an aha or something you learned from last week's conversation if you were on?
I'll go, Julie.
Thank you, Natalie.
I just thought you did a great job at kind of having a positive spin about how higher interest rates actually mean that our economy is doing well because folks can afford more. And I really loved your Taylor Swift tie-in too. And it just made so much sense. You're like, yeah, right. That is kind of a bonus spending. And if people can afford stuff like that, then they can afford higher interest rates. And I think that is such a pop culture moment that people can kind of understand and feel, like tangibly feel.
Right. Okay, good. I'm glad that helped. And think about when you tell your clients that, right?
Totally.
So we
Yes.
got to ask the questions. If they say, oh, I'm worried about higher interest rates, then you say, okay, let's talk about that, right? What are you worried about? Okay. And then, well, where else are you spending more money, right? Because it's likely you're spending more money on everything. And so that means your house too.
Sure.
Now, so I'm glad you got that spin. We are going to talk about a little bit of the downside today with the interest rates, but I wanted that simple explanation for you guys. That's exactly. So the overarching thing is if people can't afford it, right? They're spending too much, which means the demand is going up. So are interest rates. Okay, so if interest rates are higher, it means the economy is going great. People are spending more money than they should. And yet the Fed is saying, okay, let's try to slow them down. And we're going to slow them down by increasing the interest rate. Good. Thank you, Natalie. All right. Anyone else from last week? Kimberly, I saw you come off mute, but that may just be a oopsie daisy. Okay, awesome. So yes, that was exactly what I wanted you guys to get out of last week. I'm going to share my screen now and go into my PowerPoint because last week I missed a slide that I wanted to talk to you guys about. Okay, there we go. And I realized it afterwards that I didn't do a great job of explaining Fed rate versus interest rate. Okay, so you always hear, and especially lenders say, now remember, the Fed rate is not the interest rate. That's exactly right. However, the Fed rate guides the interest rate. Okay, and here's why. Because the Fed rate's set by the boss, right? The boss of the economy here in the United States. And what they determine is what it costs for banks to lend money to each other. Okay, so that's what the Fed rate is. So the Fed rate's saying, okay, Bank A, if you want to borrow money to loan it back out to someone for a car loan, it's going to cost you whatever the Fed rate is, 3.4%, 5.4%, whatever. Okay,
The interest rate is then what it costs us to borrow that money from the bank. Okay, so the bank has to pay something. Then we as consumers pay something. And obviously that difference between the two is where they make their money. Okay, so that's important. So the Fed rate influences all the other rates, the home mortgage, the credit card, the car loan. So when the Fed rate goes up, so do all your interest rates on everything, because it's going to cost more money for the bank to get that money to lend it to you. Okay. So before we leave that Fed rate, interest rate conversation, why interest rates go up. If people can afford Taylor Swift tickets, we're likely to see higher interest rates, and make them understand that it's true, right? As much as high interest rates feel painful, it's a sign of a great economy, a nice, strong country. Consumer confidence is up. People are spending. People have jobs in order to spend and that kind of stuff. So honestly, it's a really good sign for the overall health of the economy. Okay, awesome. Now I'm going to stop share here for just a second and get to where I wanted to start us today. Okay, what did we learn about mortgage rates and how they're doing, right? How did we feel like everything was doing in the economy when we looked at everything, like jobs, spending, interest rates, that kind of stuff? Does anyone remember? Okay, because what we saw is everything's doing exactly what it should. Nothing's crazy out of whack. Okay, so things are going up, down, like they always do, but our normal trajectory is still happening. Okay, so that's what we're trying to figure out. Like, why are things out of whack, right? Because so far, everything's looking real good and in line. Okay, until we get to this one. And then we're going to dig into housing stuff specifically. Okay, so here's where it's becoming a problem. So, sorry, didn't mean to do that. This is the payment to income ratio, debt to income, right? What are you spending out versus what are you bringing in? Okay, versus the interest rate. Okay, so I'm going to break this down for you. The green line is the interest rates. Okay, Freddie and Fannie, what the interest rate is doing, where it's going. Right now, we're seeing it a little bit above 6. Last week, we saw the 50-year historical average is around 7.7, right? So typically, this interest rate should be okay for our economy.
Good
But
morning.
here's what's happening. Now, because the interest rates are higher and because houses are higher, expenses are higher, insurance has higher, everything else has inflated as well. What's happening now is that the percent of the income that the mortgage is taking up is higher. Okay, and see how these two lines are getting farther apart. So this is what the rate's doing. This is how much it's costing people, the percent of their income. Okay, so 34% of their income is too much. This is too spread apart. That's why it's feeling hard for your people to spend money on mortgages. Okay, so this is what everyone's watching right now. Okay, now here's the interesting part. Again, I'll go off on a little economic kind of tangent, but the consumer pricing index, the CPI, they take into account all of the stuff that is costing us things, right? So they're watching the inflation versus all that kind of stuff. What is not included in there? So rent is included, mortgage payment is not. Okay, so at your national level, your association is having those conversations right now to say, hey, gang, we got to look at this. From a national level, you guys have to pay attention to this, how much it's costing consumers to hold a mortgage. Okay, so hopefully that will change and mortgage payment per month will be considered in the CPI. Right now, it is not. So that's super interesting also. Okay, any questions right there? All right, so now we're going to just talk about housing stuff. Okay, so we're just going to talk, we're going to switch now. We know the economy is good. We know interest rates are going up. We understand why. And now let's just talk about what's going on in houses, in real estate. Okay, so sorry guys. I go to click on that screen and then I forget it. I'm trying to look at that screen and get it front, and then I click on it and it moves it. Okay, so all of it's about supply and demand. Okay, give me your digital hand if you basically understand supply and demand. You guys know how to raise your digital hands or put it in the chat box and say, I get it, I don't get it, talk to me about it. Let me know who's on here. Okay, awesome. So it looks like we've got a general understanding here. So yeah, when more people want it, it gets more expensive, right? So we talked about that last week, how more people want it and it just kind of starts going everywhere. Sorry, I'm trying to get my screens. It starts going crazy. Okay, so in housing, we're watching the supply and the demand, and we're watching it by new listing inventory, new construction inventory. The way we look at that is building permits pulled. Okay, so those are the key things we're watching to see, do we have the supply we need for the demand of people out there that want them? Okay, what would you guys say is the answer to that question before we even start? Anyone?
No.
Do we have
No.
enough?
No.
No, we do not. We do not. And we're going to jump into that. So I'm sure all of you guys have heard that. We have low inventory, low inventory, low inventory, right? But let's really look at it and understand where we're at. Okay. So here we are on the supply of homes. Okay. This is the inventory of homes we have. All right. Tell me if I need to scroll in. I will, so you guys can try to see these. I'm going to put always national and then what we have for local on the other side. Okay. So this, you can see it's from realtor.com. Every single month, they give you this chart. Okay. So realtor.com, you guys can go clip it off of there anytime you want, any month. We're always a month behind, of course, because they have to gather the information and then compile it and get it to you. So here's what this is showing us. This is 2017 at the top, all the way down to 2023, starting out right here in the middle. This is active listings and where our active listings started at the beginning of this year. So as you can see, we are down. We're down from these 4 years, 17 to 2020. We're up from 22 and 21, right? Which we expected. Now, seasonality. The natural trend of houses. You can see it. January, we start down, we get up, we hit our peak around July and August. September, we start pulling back down and go back to December, where we just start the next year. Okay, that is normal seasonality. Okay, what year was not normal seasonality on this chart? 2020, the pandemic hit. This is the only line in the whole thing. And if you put, there would only be a handful of these in the history of the economy if you put every year forever up until it. Okay, so let's look at that line. Can you guys see my mouse? My little hand that's going? This green line in the middle is the pandemic year. It's the only time it kind of started out and then went, oh boy, where are we going? Okay, so far, active listings down. We're following the same trajectory, right? Nothing super out of whack except that we're down. Indianapolis market. You guys should have these at your local MLSs if you're not from Indianapolis market. MyBoard puts this out every month as well. Okay, it's a great chart to look at. The board is studying this with many other charts. Every month they look at this when they have a board meeting. So we're looking at the maroon line is the closed sales year to date. Active inventory is the orange bar. Okay, so it's currently sitting on the market. And then how many new listings have we had this year? Okay, so you can see the trend, right? We dipped in 2020, 2021, 2022, we're coming back out. And here we go. 23 is starting to steady, right? So new listings, the blue line is where we're down. Okay, so you can see this one, and then now we've dropped down even before pandemic years. Okay, so this is where we're concerned right here. Okay, and we need more active inventory, obviously, to help with the new listings. Okay, so what did we learn on that one? Our supply is low. It's trending the same way we expect it to trend. And we have to keep watching this. And part of the reason it's potentially low is because of the cost of mortgages for people, right? And can they move? The other thing we're going to talk about is the affordability, right? So the affordability of the mortgage, the affordability of the house, even if you're paying cash. Okay, any questions? Make sure you're hollering in the chat, coming off your mute, whatever you guys need to do to ask questions. This is your safe space, because believe me, if you're thinking it, so are other people. So don't wait to ask. Okay, let me zoom that out so then I can go to the next one. Okay, so this is our supply that we're watching. Now, how do we tell the demand? Okay, so this is a difficult one sometimes. So here's what we use. Oops, sorry. Oh my gosh, you guys, I suck at this. Okay, so future demand, we're looking at our resale properties. Okay, so this chart right here is our resale existing home sales. Okay, so you can see we were kind of doing great here. We had a little dip. We were pretty even up to 2020. Then we plummeted. Then we came back strong, probably making up for some of this, right? And then now we're back down on existing home sales, pretty low here, lower than we have been, right? We're looking at just a little over 4 million. And really our comfort level is around 55 million, 5.5 million. Okay. However, the upside is that building permits are up. Sorry, I got to move this a little on my screen so I can see it. So this is building permits. What Baggy and the country uses building permits for is to gauge the strength of the housing market coming up. Okay, what will we have for people? Because obviously if people are building things and giving people more options, it gives them opportunity to potentially move and starts the whole wheel going. Okay, so this is the only real guide we have to kind of show us where might we be going. Okay, so the good thing is that new construction is back above pre-COVID. Okay, so while resale's down, new construction's up. Okay, so this is going to help everything. So that's a good sign for all of this. However, here's the issue. Okay, so I've shown 2 slides that are really the issue. That's separation between the mortgage cost per month and the mortgage rate. And then this one. Okay, so this is Indianapolis right here. New residents is the red line. Okay, this is the people we have coming into Indianapolis. New residents that we have coming here, considering our city for a job. The yellow line is we're going to start with the blue line. The blue line is the housing permits. Okay, how many housing permits did we have at this point each year? Okay, this is April of 2023, because we're always a few months behind on this one. So as you can see, April 2023 was down just a little, but man, we're coming back. And you guys have probably been feeling that, right? We're on an upswing as far as building permits, which is good for everybody. Okay. However, this yellow line is the deficit. Okay. So this is how many people we have. This is how much we have to give them potentially. That's the guide of it. And here's how much we're missing. Okay. These 2 lines are why you've felt what you've felt the last 2 years. It's why the demand is up like crazy. People are still buying, and mortgages cost more, houses cost more, and they're still buying. Okay, so go back now to the Taylor Swift tickets. If people can afford to buy Taylor Swift at a super high price, they're also clearly able to afford our houses at this high appreciation, high mortgage rate, high everything right now. Okay, but we don't have enough houses for them. And that's what we have to figure out, is this deficit between the two. All right, I see a hand up. Is that a question? All right, now's a good time if anybody has a question about what we're looking at so far on our supply and demand here. Anyone?
Question.
Okay. Yes.
So the difference between the yellow column and the red line, is that the difference between new buyers versus people who are currently homeowners who are in the market wanting to sell and then buy a new house?
Yeah, ish. So what the yellow line is saying, how many houses are we missing? It's the deficit between what we're actually gonna have based on where our resale inventory is going, based on the new construction permits coming in, based on what they see as far as resident turnover in Indiana every year, and how many houses they actually need.
So with where the red line is that telling me that
That's
new residents,
residents.
we have a third of new residents compared to 2/3 people still in the metro area who are looking to buy or sell? Is that what that's saying?
Yes. So of those residents coming in, there's going to be a larger percentage of them that cannot buy a house,
Okay.
is what that's saying.
Okay.
So it's a formula, which is why I'm having trouble kind of answering your question specifically, because this is a formula. So it's not a direct number to number representation necessarily.
And then my second question, kind of on a different, so is Bloomington market a little different than the Metro Indy market because of the university and just the number of people coming in and out?
Potentially. I mean, yeah, you guys have to watch your current markets completely. I guarantee Bloomington has a chart like this. What are you feeling, John? Or what are people feeling down there? Do you feel like you have more supply than we do for the people that want it?
Not necessarily. I think we're still kind of somewhat close.
Okay. So then you probably are seeing the exact same thing here.
Yeah.
Okay. So you probably still don't have enough houses for the amount of people. So really, I would have to imagine your people moving in and out are fairly similar every year, right? They're going to do a littler wavy line.
Correct.
But your deficit is getting farther also.
And people are looking to build wherever they possibly can. So, as you're indicating.
Yes, that's exactly right. Builders are looking to build. Consumers need them building anywhere they can. But consumers need them able to build it affordably. And that's the challenge, right? Because everything's gone up. So labor's gone up. Materials have gone up. Land has gone up. The cost to do business has gone up. So everything in the houses is more expensive too.
Thank you.
You're welcome. Anyone else?
Yeah, Julie.
Yes.
So I get it that the rates have gone up, but the demand is still up and people are still buying. And 50-year historical rate 7.7. So we're still relatively, I can tell all that to somebody, but if they say, I can't afford it, there's really, do you know what I mean? I don't want to say, yeah, but people are buying $3,000 Taylor Swift tickets. I'm like, I didn't.
Right.
Since it's like, I need something to say to the person that's going, I'd love to buy, but I can't afford it. If they feel they can't, I can't tell them, sure you can.
Correct. No, they can't afford it. And that's the point.
Yeah.
That's the entire point, is that people who can't afford it need to step out of the market. So the people who can and the people who have to have it get access to the supply, because mortgage payment, right?
Right.
So, and that's right. That's the hard part, gang. But this is exactly where realtors were in a completely different situation in 2008, because we were telling a different story. When I sat down with my clients and I said, let's look at your budget, the lender's saying you can afford this, but we got to look at, are you going to be house poor? Like, just because they'll approve you doesn't mean it fits into your lifestyle and your budget.
Right.
Okay. And we had to sit down and coach people all day long out of, I'm sorry, I think you're just in the wrong market. I don't think it's in your best interest to carry a mortgage at this time. If you want to, right, go ahead. But yes, this becomes our conversation. Now, you've got to get them real, though, on why do you buy a house? Susan, will you just kind of talk through this with me?
Okay.
So you be the buyer. You're the buyer, right? So if you said, so why do you want to buy a house?
Because this rent is going to nothing. I have no equity in anything, and renting is
Correct.
just killing me.
Yeah.
So there's that.
And how much do you make every year off the investment in your house?
I don't know how to answer that, Julie.
Okay, we're going to talk about that. In Indiana, it's about 3 is where we average out over time. Nation is around 4 to 5%. Okay.
Okay.
So
there
you
you
have the opportunity to make 3% every year off of your house,
Yeah.
right? Where else are you spending money that you can do that?
That's a good response. Thanks, Julie.
And so the real question is, can you afford it? Or is it a matter of really looking at your investments and putting your money towards something that's going to make you money versus other things that you're spending on in your daily life that won't? Okay. So that's how we redirect them back around to, we don't say, well, you bought Taylor Swift tickets or you didn't, right? But you redirect them back to, so, and then maybe you need to sit down and study your budget a little more and just see, is there an opportunity to maybe free up some money from other places in your life in order to invest in the long term, what we're trying to make on our house? I'm going to stop share because we're almost done here and you guys don't need to stare at that. Okay. That's the conversation you have to be having with buyers. Why do you buy? Right? You buy for a long-term investment. You buy for a tax benefit. You buy for the ability to punch a hole in your wall and not have anybody yell at you. Right? You buy for generational wealth. That's the biggest one. You buy to reborrow for your college if you need to. Right? In a lot of years. You buy to be able to give money to your kids for their weddings, for whatever they need to buy themselves houses, right? So buying is a lot bigger conversation than just the interest rate, of course, right? And then it's a matter of how you're spending your money. Now, if you go through all that and they're like, yeah, we just don't have it, right? They just don't have it. So,
Yeah.
Okay. So it's a difference between, can they do it or do they just feel like they can't do it?
And you'll probably touch on this next week even, but I have people that have been ready to swing the bat, and then on high-end homes, and he just flat out to me goes, yeah, we're not going to buy this year. We're going to see what the market does.
Okay.
Like, so I need some responses for that. So
You got it. And yeah, we're going to get into appreciation next week too. So why are they waiting?
Well, I can't quite figure it out. I mean, as well, these rates, the market, we're going to see. And I don't know if that's just your, blah, 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 just that you've just chickened out for whatever reason. But
Some of it could be
response to that.
Yeah. And this is the one you'd need to show them.
Yeah.
Is this screen right here. Right. So if you're hoping to not buy and get out of the market because prices might go down, they're not.
Yeah.
Okay. And here's why. And we're going to dig into this. You guys haven't even seen this sheet yet. So we're going to do this next week, but just because it's up here to show you guys, this is what home prices are doing. This is the small snapshot between June 22 and June 23, right? So we see this dip, but then it came right back up. Now, who lost money in this time period? Only the people that bought it right here and tried to sell it right here. So if you bought in June and sold in November, you lost money. If you didn't do that, which most people didn't, you didn't lose money. Okay. So the whole conversation of, and we are going to talk about this, right? Should I buy? Is now the right time to buy? It depends on what your goals are for housing. You will make money. Do you want to make 3% every year on it? Now, what I can't give you is the 12% we have been having, but this is the historical. For 23 years, here's the median home price. And the prices are just doing what prices do, right? We are just right back to exactly where we should have been. So even though we kind of leveled out down here a little bit, we then went way up above the average. And so we've pulled it all right back down. Okay, so if people say, can I buy now? Will I make money on my house? The big question is, how long are you going to be there? Okay, you can make in Indiana around 3% every year. It's going to cost you around 8% to sell. How long do you have to be in your house to break even, right? 2.5 years for sure. Anything on that's bread and butter. Did that help some?
Yes.
Okay, hopefully. All right, you guys, we're at 9:02. Sorry to keep you over. We're going to keep digging into appreciation and everything. And then I promise we're going to have a whole thing on now. How do we talk about it? Okay, so stick it out with me over the next couple weeks. You guys are awesome. If you have any specific questions, make sure to text them to me, email them to me, whatever. I'll see you guys next Tuesday.